All right, hello everybody. Thank you for joining us today. I'm Michael Schneider, financial advisor with the Learner Group at Hightower, and I'm joined with J.R. Gondek, partner with the Learner Group at Hightower Advisors. And we're going to start doing these monthly market recaps, provide some insight to what we saw last month, and also give a little bit of an outlook for what we see moving forward. So, J.R., November was a great month for the markets, and I think a lot of it had to do with the election results, vaccine news, and I think that brought a lot of cash back into the markets. Can you talk about where it went specifically and sort of any other points you thought really helped bring markets to where they are today?
Yeah, the market performance in November was shocking across the board. I mean, it's been such a difficult year with COVID, the election anxiety, and everything else. And to have clarity and pass the elections and then the vaccine news on top of it just brought historic money into the markets. And pretty much every asset class went up in value in the month. And as we look ahead, it wasn't even. We talked much of this year about kind of our barbell approach of how we've invested on growth portfolios for much of the year, where our barbell is defined as large companies on the one hand and smaller companies on the other. And it allowed us to maintain a fair number of cash holdings throughout portfolios just because we didn't know for much of the year. And as you look at the performance in the month, everything went up, but it wasn't equal. So when you think about the comparison, Michael, if you could talk about the difference between the S&P 500 index, and then if you equally weighted those 500 companies, the difference in that performance.
Sure. So the S&P 500, as we know, is just a market-weighted index, and in November it was up, give or take 10%. When you look at those same 500 companies, but you take away the market weightings and just have each company provide the same input to the overall return, that equal weighted index was up closer to actually 14%. So we really saw was more of a broad range of recovery, not just focused on the top companies within the index.
And it doesn't sound like a lot, but it's a massive difference, 4% in 1 month, to have the breadth of the market, as Michael said, the smaller weighted companies to move that much. And when you look smaller companies below that, many of those were up over 20% or greater in the month of November. And when you look at longer term, smaller companies have just underperformed for many, many years compared to the broad indices. And it begs the question as we look out of these 10-year cycles between either growth and value overall, which have historically been kind of 10-year cycles. When you look at the 90s, much of that was a growth market. You look at the first 10 years of the 2000s, that was much more of a value. And the last 10 years has been much more of a growth. Maybe we're setting the stage for a shift ahead, and you're seeing the data to support that between smaller international and value companies looking to outperform maybe for the next 10 years ahead. So it's something we're watching for. And again, November was another period of time where it supported that potential thesis looking ahead.
Okay. And I think one thing that we've been hearing about lately in the news has been the idea of margin expansion for companies. Can you really explain what that means? And I think we can talk probably give a couple examples of different industries where we could see that impact.
Well, when you look at the shift between kind of growth and value, one thing you find and we're concerned about ahead is inflation. And inflation isn't likely to be in the government statistics, just like the period of time from, let's say, 2003 to 2010, where you had a huge housing and building boom. When you look at margin expansion, let's just give an example of a copper mine. Copper prices have gone up a lot recently. They're at multi-year highs because of the recovery in China in demand and the likelihood of the housing boom and construction boom continuing in the US with maybe an infrastructure bill next year. So if you think about copper price, if you own a copper mine and you have thousands of employees, let's say, and copper prices go up 50%, you don't need to hire more people to mine that same copper. So the price just drops to the bottom line and you get margin expansion or more profit for doing the same thing. So you could see a lot of that fuel many smaller companies, many commodity related companies. And it's the same thing when you look at a lot of the commodities throughout the world. Many of the emerging market countries benefit greatly from iron ore, copper, and many of the commodity prices. So it could support that shift and that margin expansion in the commodity is a great example of why that could provide some good opportunities ahead.
Yeah, I think that makes a lot of sense. And it sounds like a lot of these companies are just becoming more efficient within their operations. I think, as you mentioned with mining companies, you look at sort of different industries, you look at the retail sector, for instance, that a lot of these companies have pivoted more towards online sales, that they have been able to cut out the sort of the middleman. They don't need as much in terms of their physical, brick and mortar space. And because people are shopping online, these companies now have more information on their customers, which allows them to provide their customers with more targeted ads, whether it's for things that they know that they're looking for more. Like if you're buying say a pair of shoes, maybe you need a pair of socks to go with that. And that's, I think, a way that these retailers are able to, increase sales while decreasing their costs. And again, just get back to the idea that they're downsizing their overall cost structures. And as markets sort of recover, because they're now more efficient, they don't necessarily need to raise those costs back up to where they once were.
That's a great example, Michael. Restaurants are another example. As you read through the earnings reports from many of the restaurants, they've lowered their menu items, right? So you used to have maybe 100 menu items, and you might have 25 today. So it's brought down the cost to operate, and the efficiency of restaurant is another example that they've had to survive at, let's say, 50% capacity with fewer items. And as business recovers to, let's say, 60 or 70% capacity, they're not likely to bring back a huge number of extra items. And you're going to have this similar expansion. And the same to your example in retail. The inventories of many of the stores, brick and mortar, is a lot less. So they don't have as much physical product sitting on the shelves. And it's much more efficient to ship from a warehouse or from that local store. And the margins are much, much higher. And think about all of us as consumers. I mean, how frustrating was it to stand in line for 10 or 15 minutes waiting to check out? Now you order online from the local store, drive up, and they put it in your car. It's so much more efficient for the store and all of us as consumers. And again, all that fuels that margin expansion we're watching for in probably the quarters ahead.
That's, I think we're all looking forward to seeing how this all plays out, especially once we get that vaccine and see how we can return to more of a normal life again. Just one other thing I wanted to touch on with, as we briefly mentioned before, the election results is something that had brought money back into the sideline, a bit more confidence within the markets. With President-elect Biden nominating Janet Yellen as his Treasury Secretary, what do you think of that, and how important do you think that her nomination is to the markets and the broader economy?
It was a fantastic nomination. I mean, and you could see the markets reacted very positively, because what that'll be is confirmation of the new White House and administration working very well at the Federal Reserve. And these are two key entities that matter a lot from investor confidence and what's going to happen to the economy in the months and quarters ahead. And Janet Yellen, being the former chair of the Fed, working closely with Jerome Powell, the current chair, it just brings continuity to, and there shouldn't be very many surprises in the markets, at least near term. And that's why you've seen the markets really rally on that. And it's a good sign as we look ahead. Having said that, as we enter December, the third day of December today, you'd expect some normal correction in the markets near term. But again, as we get through the normal ups and downs and likely that the profit taking that you could see near term, a lot of what we see with some of the longer term trends we're talking about today, we think will play out in the markets ahead. So with that, we want to thank you for listening, and I hope everyone stays safe. Enjoy the holidays, and we'll talk next month.
All right. Thank you, JR. Thank you, everybody. Appreciate the time.